You guys hear me good? So yeah, so I know you all want me to give you the answer, and I want to give you all the answers. It's just that the answers are different, and the answers change. So like, you know, what works for you today is probably not going to work for you next year. And so what I want to do is I want to give you the framework of how to think about these things so you can understand where you should be today, but also how you need to evolve as your situation changes. And so, you know, it's like I can give you a fish or I can teach you to fish, right? And so I want to give you the fish, and I'm going to try my best, and we're going to go into a pretty long question and answer when I'm done, so we can get into some specifics. I'll do my best to help, and that will help everybody out. So I want to give you the fish, but I want to show you where to go get the fish. I want to show you how to get the fish, and so that way you can learn. Now, one thing that I don't have in here when it comes to asset allocation and portfolio, but I want to just talk about for a minute, was what Dr. Watkins opened up with this morning. How cool that was when he talked about building generational wealth, building lifetime wealth. Yeah, I like that. What I really liked about it that I thought was super powerful, and I'm going to steal it and start using it, was the analogy of like LeBron James growing up. And I heard earlier in the Q&A, someone said, how fast can I start making money? This isn't like a sprint, right? Like, I'm not like in Vegas for one night and I'm going to go in the casino and see how much I can pull out. This is like a lifetime. I talked about earlier in one of my presentations about building, you know, lifetime wealth or whatever. I talked about, like, I'm trying to set up my grandkids. I'm not trying to see how much can I extract in the next 30 days. Now, I get it that some of you guys might be in a situation where you want to do that, and there are ways to make money. So I guess there's like two ways that I might think about approaching the cryptocurrency space, or the investing space for that matter. It could be stocks or Forex or whatever. So I would generally break those down into two areas, and I would say you have investors and you have traders. Okay, so you can be trading in cryptocurrency, and that could be done for cash flow. That could be like a job. You could be earning money today trading cryptocurrencies like a job. Investing is not income. Investing is putting money away that's going to continue to grow and is going to be worth a lot of money in the future. And for a very easy analogy to that, I like to use real estate, because everybody gets real estate. So you've all seen all those shows on TV, fix and flip, love it, whatever, this or that, right? And they find a house that's all beat up and they fix it up and they sell it. And we all know there's all these courses and they can teach you how to fix and flip properties. So people that fix and flip properties, they're not investors. That's like a job. I buy it, I spend a couple months fixing it up, I sell it, I make money. And that's great, and that's definitely a way to play it. Then you have real estate investors who are looking to buy an undervalued asset, one that they think will appreciate over time. They can get renters in there, they can make income, and they hold that property for a long time. That's an investor. Now you can be both. I can be buying and selling properties for cash flow and then break one or two off here and there and move it over into long-term holding. But I just want you to understand there's two different ways. And so when I think about investing, and what Dr. Watkins was talking about this morning, investing, it's not about quick money. So I liked what he said about the analogy with LeBron James. Maybe you don't see it in 30 days or 60 days, but over years you'll see it. Now, that being said, I love cryptocurrency because it is explosive. And you can see money, but sometimes as explosive it is to the upside, it's explosive to the downside. So you got to be careful for that. And that's why even when, like, in December we were doing live videos, and I remember Charles especially was getting like super excited about how much it was going up. I was like, all right, but just remember, like, it's gonna go back down. Like, I'm telling you right now. And then I just try and think about, like, you know, when I talked about life-changing wealth and really staying in to see that trend. How would we have been lucky enough to get Bitcoin at 1,000 and ride it to 100 million? And that's through staying in the trend. And so that's why I said, even if Bitcoin were to hit 50,000 or 5,000, either way, I'm not going to sell. So I'm not really concerned about what it's doing right now. And I know one of the panelists up here said that today, there's really no good use for this stuff. So, and what I mean, I don't mean it's worthless. I just mean that we're so early in this trend that it's just not something that we're using today. So I liken it to going back to the internet in the early days of 1995 or whatever. The technology was there, companies were being built, the vision was there, but nobody was really using it for 10 years later. And so we kind of have to think about that. But anyway, I'm going to talk about the number one secret to success in investing. I'm going to say about cryptocurrency trading and investing, and that is to build your perfect portfolio. So the number one rule to success is not finding the best company. It's not about being lucky. It's about having a strategy. That's what it comes down to, having a strategy about building your portfolio. So, let me turn this on. All right. Ray Dalio, Bridgewater Capital, one of the largest fund managers in the world, $150 billion under management. $150 billion he manages. And he says that because no one can predict what kind of an economic environment we're going to see in the future, it makes sense to prepare for anything. So what he's saying is that the smartest people in the world are smart enough to know that they don't know what the future holds. I told my story earlier that I thought I was super smart. I was in real estate. I was able to grow my portfolio super big and super fast because I was all in. And when it crashed, I was left in the hole and I had nothing. I had no money. I didn't diversify, right? You all know diversify. I had to live it, and it sucked. It was painful. So I thought that the real estate market was hot. You know, because I like to study history, I studied the past history, and I recognized that a crash was coming. But what I was doing, I couldn't get in and out quickly. I was building projects. These were 2-3 year deals. I couldn't just like get out. I was like in it for years. And I had even had other investments that I sold to get additional income to grow my real estate portfolio even faster. And when I look back, I don't have a lot of regrets in life, but one of my regrets was that one of my real estate apartment buildings was like my safety net, and I sold it to do this other project that I ended up losing all the money on. But it's like, why? Why did I sell that one? Like that one, like I didn't need that last one. That was my safety net. So the power of being diversified, because you don't know. You don't know what's going to happen, and as good as I feel about cryptocurrencies, I don't want to put all my money into that. So we want to, success leaves clues, so we follow other successful people. We try and do the same things that they're doing. And so asset allocation is a strategy, and it's coming up with a strategy to divide your investment portfolio. And so typically we want to put them across different types of assets. And so if you don't know what different types of assets are, I'm talking about things like stocks and bonds and keeping cash, gold and silver, real estate, like I've been talking about, of course. And so I'm organizing them into different types of allocations, and I'm diversifying. And ultimately what I'm trying to do is I'm trying to diversify them across... Oh, I thought I was bringing me some batteries. What's going on here? It's going to be fun. You got some batteries for me or something? So diversification is it's a technique that mixes different types of investments. All right. And I know, and I'm going to get into nuts and bolts on this, so we're going to talk about how you apply this. So it depends on where you're at. So a lot of you people might be like, well, shoot, I got $1,000. How am I going to diversify into real estate? Well, you're not. So we're going to talk about where you might be, and we'll talk about ways that you can apply this. And like I said, depending on where you're at, there's different types of strategies, so we'll get into that. But ultimately, we're looking to spread out our risk, because we're not gambling at the end of the day. And people sometimes want to know, why do I think 30 cryptocurrency positions are the right amount? And typically, the most frequently asked question I get, especially to people that are coming in new, I mean, like 90% of the questions I get from new people are, which one should I buy? Okay, which three? Which three are the best ones? Just tell me the best three. And I'm like, if I knew the answer to that, all my money would be on those three. Why do you think I'd have 20 positions if I knew which one? I don't know, right? I don't know. And so, so we play the field, and we're not gambling. And you know, I talk a lot about thank you, the difference of risk and reward. Great. So as an investor, I'm always looking at risk to reward ratios, and I want to make sure that my reward is greater than my risk. And so you know, if I were to put all my money on one coin and it hit big, man, I'm feeling good. But what if it doesn't? Then I lose it all. And so the upside of winning big is not worth the additional risk of losing it all, because when you lose it all, you're out of the game. You're done. Game over, right? Like if you play video games, right? Like you're done. You're out of the game. And losses are asymmetric. So that means if I lose 50% of my portfolio, I need to make back over 100% just to get back to even. So losses are asymmetric. So I know this sounds oversimplified, but this is a rule that I try to live by. And it's that the number one rule to making money is to don't lose it. And I know it sounds silly, but simple. But like I said, most things in life are simple. They're very hard to do. And from someone who's made millions and lost millions, I can tell you that making money is hard, but keeping money is even harder. So we always want to protect our downside, and we do that through diversification. So there's 4 principles of diversification. So we want to diversify across different asset classes: real estate, stocks, bonds, etc. Diversify within the asset class. So even though I put money into stocks, I would want multiple stocks. Even though I put money into cryptocurrencies, I'd want multiple cryptocurrencies, etc. I have money in real estate. I have some real estate in Indiana, I have some real estate in Florida, and I have some real estate in Arizona. I'm diversified across that. I want to diversify across markets if I can. Like I said, multiple states, multiple countries if I could, and diversify over time. So I'm investing in different periods of time. So that way I'm just protected. I'm spreading it around where they're not going to damage each other. So the key to diversification is trying to find assets that are balanced according to risk. Because some assets are more risky. So like, for example, rental real estate is pretty safe. Even when the real estate market crashed, the worst we've ever seen in like 2008, 2009, rents stayed about the same. So that rental income was pretty safe. But we also know that like cryptocurrencies are pretty volatile and pretty risky. So I want to balance the risk. It's not the dollar amounts. I wouldn't say I have $10,000 invest, so I invest 5 and 5. I need to balance for the risk. And like I said, we're not gamblers. We're not gamblers. We're not here for a night. We don't have 2 hours in the casino. I want to make sure when I'm old, I have money. I've lost it all. It sucks. It's scary. And I want to make sure I'm playing this long game and I have the right perspective. So we don't go all in. And that's why I said, like, even as good as I might feel about one position, I'm just not going to put too much in, all in or even too much in. And we're going to talk more about that. I know I'm starting really general and you're all chomping at the bit, and we're going to get to specifics. So again, risk to reward. We want to always balance that. I know, so for me, I love cryptocurrencies because we have that asymmetric return. I told you guys earlier that when I really had to dig deep and study for myself so I could learn this game, I learned that the best traders in the world or the best investors in the world look for asymmetric bets. That's what they look for. Because they want to have that unlimited upside. If you don't know what asymmetric, symmetrical means it's the same on both sides. Asymmetric means one side is bigger. So it's bigger on one side. The upside is bigger than the downside is. So I'm balancing my risk to reward. So typically, any picks that go into the Jarvis portfolio, I think they have at least a 10x return on the upside. And the downside is very minimal. So if we could turn 5,000 into 20,000, that's a big upside. If I lose the 500, it's not that bad, right? So those are the way that we're looking at it. I know from a trading perspective, if I'm trading stocks, Forex, or trading cryptocurrencies, typically you'd want to open a position with like a 3-time upside and a 1-time downside. So I could have a 30% win with a 10% stop loss, right? So you're always trying to manage that risk. And the reason why you have to be prepared for anything is because of the markets, not just the stock market, the markets themselves, they're unpredictable. And even when they're in strong uptrends, it's not a straight uptrend. And when they're in a downtrend, it's not down. And so what was discovered, there was a really good book that I recommend. It was written by Tony Robbins, and it was Money Master the Game, I think it was. And he studied, obviously he has access to some very high-level people, and he interviewed all the best money managers in the world. And the book is really good. I actually listened to the audiobook, and then I went and bought the book because I wanted to be able to reference it. And what they figured after all these studies is that a lot of people's retirement really comes down to luck. Are they retiring when the market's up, or are they retiring when the market is down? And I don't want my future to be dependent on luck. That doesn't work for me. I feel like I've been pretty lucky in life. I consider myself pretty lucky, and still I don't want to play those odds, right? So I want to have a better plan. So I know that assets are going to change, and I want to be able to plan for that. So a quote that I like to say often, so we're talking about investing principles. I like to always say that principles are few and methods are many. So what that means is that the key principles in life, there's only a few core principles, but there's always a bunch of ways to achieve that. So for example, I need to save so that I can invest and I could grow my assets over time. That's a principle, save so I can invest. The method of how I would save, or the method and way I would invest, there's thousands of variables of how I could do that, right? But the principles are key, and that's why I think it's important to understand all these different markets, because they're really a lot more similar than you might think. So, investing principles have been around for 100 years, and they're just still relevant today. And even though cryptocurrencies are brand new, they're just as relevant today as they were before, just like any other asset class that we have. And here's some ways that we look at the market. So these are things that move prices, and so we want to know. We don't have a crystal ball. We can't predict the future. We know that we need to be prepared for the changes in the future, but we do look for signs. It's like, how long is it going to take to drive there? I don't know, but when I see the sign, I'll know, right? So it's like I know what signs I'm looking for. So typically, when we have higher than expected economic growth, we're going to see a rising economy. When we have higher than expected inflation, we'll have a rising economy. When growth and inflation's falling, we'll have a shrinking economy. So when an economy shrinks, it pulls back, things go down. There's less money in the system, people aren't spending as much, people aren't borrowing, buying as much, etc. So you can look at some basic weather signs, right? Look at the weather vane, which way is the wind blowing, so to speak. And we can just kind of look at, GDP reports come out, government puts out reports or whatnot. And we can kind of get an idea of where the markets are going, but really we're trying to plan for both. And what fund managers like Ray Dalio do is they look for what's called non-correlated assets. So for example, on the top right, we might have emerging equities, commodities, and cash, and in the bottom left we might have gold or whatever. So bonds and spreads. So there's different types of things that you can look at. And traditional asset classes that you could think about would be stocks, bonds, real estate, cash, commodities. And then I put speculative plays. I didn't put cryptocurrencies on there. Cryptocurrencies can be in a lot of these different categories, and I'm going to explain that to you in a minute. But speculative plays are the ones where you're trying to get that home run shot. It's extremely risky, but you can probably win big. I would definitely put ICOs, investing in ICOs into that. ICOs, NXT ICO did over 1,000,000% return. 1,000,000%. It's like $1,000 turns into $10 million bucks. That's pretty good. Several ICOs did 78,000%, 68,000%, but 46% of ICOs went to bust. So it's risky, but if you get it right, you can knock it out of the park. So that's what I call speculative plays. And there's definitely a place for those in your portfolio. And I've talked to some of you guys about coming up with a strategy to do that, and we're gonna talk about that. So how do we put all that together? That's all really high level stuff, but how do we put that together? So there's three parts. We have the asset allocation. Then within the allocations, we have asset diversification. And then within the asset diversification, we have position sizing. So we're going to go through each three of those, and we'll figure out exactly how much we're going to put into each position. So first, you have to decide what's right for you. And this is where it gets difficult for me to give you exact information because your answers are different. So here's the criteria that you want to think about. So like I said, asset classes have different levels of risk and return. Like rental real estate is a lot safer than ICOs. You want to consider your risk tolerance. And that's different for everybody. Some of you guys might have seen my stuff on, Charles posted some stuff, and like, I do wheelies on the highway at like 100 miles an hour, and I surf like 30-foot waves in Hawaii. So like my risk tolerance is maybe higher than yours. And that's not good or bad. And actually, my risk tolerance has hurt me pretty bad because I take unnecessary risk. One, I have metal in every limb of my body, and I've also lost lots of money. So I have to slow myself down. Some of you might have to push yourself to be more risky. So I learned any overdeveloped strength can become a weakness as well. So we have to balance it out. But you have to understand what your risk tolerance is. What are your objectives? What is it? What's your goal? What's your time horizon? That's a really big piece. And how much available capital do you have? Those are all things that you need to consider. And like I said, these answers change because as your retirement time horizon changes, you need to think about that. As your income level changes, you need to adjust for that. So investors with a long time horizon, so people that are younger, and they have more money, larger sums of money to invest, may feel more comfortable with higher risk because they have a longer period of time to earn that money back. If I'm young and I make a bunch of money and I lose some today, I got 30 years to make it back and I'm making a bunch of money. Who cares, right? But if I'm retired or a couple years from retirement and I'm in a pretty low income, I can't really afford to lose money right now. So I need to be very conservative. And so you can understand how that changes as time goes on. Also, investor with smaller sums and shorter time spans may feel more comfortable with lower risk because you don't want to lose it, right? And so we'll give some examples of that. So basically what we do is we would break it down into like 4 main categories, from very safe to very risky, and then there's a couple in between. So we'd have a conservative portfolio. I'm going to retire in the next couple of years. I have low income level. All the way down to the bottom is aggressive growth portfolio, where again, I'm younger. I make a lot of money, and I'm okay with taking risk. And of course, there's a million shades in between there. But I'm going to give you 4 sample portfolios, and this will be available for download for you guys afterwards. So a conservative portfolio would look something like this. That's what you guys wanted to see? Oh, the download, yeah. I thought you were going, finally something specific. All you do is talk in general stuff all the time. I don't know what you're saying. Oh, yeah. I wonder if we can like change the zoom on that or something. Oh, it's on. I think it's just... Okay, well, you'll get the downloads. Well, then not only can you take it home and study it, but then like when your situation changes, you can pull it back out and you can look at the next slide. So because we're running late and I want to save a lot of time for questions, I'm gonna get through these. I have 4 sample allocations. We'll look at the conservative one and the risky one. The 2 are in the middle. You guys can figure that out. Like I said, really I'm trying to give you the framework to think about this. So a sample conservative portfolio, and I don't know how conservative you are, this is a sample just to help you think about it, would be like, for example, I'm 5 years from retirement, I have a low risk tolerance, I'm on a pretty steady or low fixed income. So I might want to be very safe. So like I might want to put like 35% of my, so first of all, we have asset allocation at the top, it's 100%. So first thing I have to do is decide, how much do I have to invest? Do I have $1,000? Do I have $5,000, $10,000, $100,000, $100 million, whatever? The reason why I don't talk about dollar amounts is it doesn't matter. I talk about percentages. So we want to divide up our portfolio in percentages. We want to divide up our position sizes in percentages. It's not, should I put $1,000 into this position? No. You should put 2.5% of your allocation into that position. And that 2.5% is going to be different for me than it is for each one of you. Okay, so that's everything I'm going to talk about is in percentages. But you first have to start with 100% of my allocation or my investable assets. 5,000, 10,000, 100,000, 100 million, whatever that is. And of that 100%, maybe I'd put 35% into stocks, 20% into bonds, 20% into real estate. Those are all very low risk, generally low risk. Now, the devil's in the details, and we can get super into the weeds on all this stuff. I might want to have some cash flow, like some real estate, 15%. I'd want to definitely keep some cash in the bank. Cash is always a good thing to hang on to, 10% in cash. And I'd probably have 0 speculative stuff, potentially, if I want to be very safe. Now notice I don't have cryptocurrencies in there. We're gonna go and I'm gonna show you where cryptocurrencies can fit into each one of those categories. I'll skip the moderate growth. And if I want to be aggressive, I have 20 or 30 years till retirement. I love taking risks and I got money coming in, then I can be more risky. So now I probably want to get rid of the bonds. Real estate I still like to keep, get rid of the cash flow, keep a little bit of cash on that, but now I noticed you put 25% onto my speculative stuff. Now, stocks is a very general statement. There's blue chip stocks like, Fortune 500 stuff that are generally safer, and then there's small cap stuff. So it's very general, but you can understand now how I'm sliding my percentages around. So maybe in this place, I might put 25% of my total investable assets into crypto. Maybe I want to put 50% of my total investments into crypto. Maybe I want to put 75%, and that's just going to be up to you. And I'll show you different ways to do that. But where does crypto fit in? So that's probably what we're all looking at right now. So where does it fit in? Well, some cryptos could fit in like in the stock category. They could fit into a stock allocation because they're generally safer. So typically the large cap cryptocurrencies, anything over like 1 billion valuation is generally pretty safe compared to small cap stuff. It's all very volatile. Commodities, like Bitcoin is called like digital gold, and is typically being held as a store of value, just like gold is. So commodities, people invest into oil and gold and silver and things like that. Speculative, obviously, we talked about that. Most cryptocurrencies are going to fall into that allocation. And then cash flow, like some cryptocurrencies can provide cash flow. And I know I was talking to somebody about master nodes and stuff like that. And so there's some stuff like that, yep. So that's understanding the asset allocation. So that's, I have $10,000 total of investable assets, and I decide that I want to put 50% of that into cryptocurrencies. So now 5,000 of my 10,000, 50% is going to go into cryptocurrencies, and now that's 100%. So now how do I want to diversify within that? So if I was a conservative portfolio, maybe 0 to 35% would go into cryptocurrency. If I was very aggressive at the bottom, I might go 0 to 70% in cryptocurrency. I can tell you for me personally, when I got into cryptocurrencies in early 2016, one, it was a lot easier because there's only a few to choose from and they were a lot cheaper. But it was just a very small percentage of my total investable stuff. I mean, I have like stock accounts and real estate holdings and other investments and stuff like that. And it was just a little bit. And now it's grown quite a bit. Now it's a pretty large percentage of my portfolio. Now, as you can see, each one of you, this amount's going to be different. And it also depends on your comfort level. Like I said, your tolerance for risk. For me, I'm at about 50%, and that doesn't mean it's right for you. I'm just giving you some practical applications here. It's grown into about 50% of my total investable assets, and obviously you know that I love it. I talk about it all the time. I'm super passionate about it. I feel like I probably couldn't be more certain than anything. I feel it in my bones. There's no way this is not going to be a massive success. I'm digging up the research. I'm posting it. I mean, last night, I saw what I would consider the 5 kings of finance are getting into cryptocurrency. Goldman Sachs opened up a trading desk. The New York Stock Exchange said they're going to start trading cryptos. Bloomberg just opened up a crypto index fund with billionaire Mike Novogratz, who's from Goldman Sachs. NASDAQ said they're going to open up a crypto trading desk. And Huawei or whatever, they make mobile phones. It's like the 3rd largest mobile phone manufacturer in the world. Just said that they're going to start sending all their phones out with Bitcoin hard wallets. 5 kings of finance are getting into crypto right now. I could not feel more sure about anything, but I'm still not putting more than 50% of my assets in. I'm just giving you guys practical applications. And maybe you want to put 75%. I don't know. But it also depends on your situation. So let me just say, my assets are pretty good size, so I can spread it around more. If I only had $1,000 to invest, I can't really spread it around. I need to be pretty risky with it. If I only had $1,000, maybe I would put 100% into cryptocurrencies. As that grew to $5,000, I might look at trying to peel some of that out. As it grows to 20, 30, 50,000, now I'm really trying to spread that out a little bit, right? So if I only got $1,000, I need to turn that into 5,000. I can't diversify into oil or real estate or all these other cool things you talk about. If you got $1 million, now you got to be on the defensive end, you see? So when you only got 1,000 or 2,000 or whatever that is, you're on the offensive. I got to make more. But as you get more, you got to be on the defensive and you got to start protecting it. So that's why I said these aren't one-size-fits-all answers. Depending on where you're at today, you need to think about where you should be, but you need to understand how you can change and how you can grow, right? And I'm telling you, I know you guys got a chuckle out of, I said the best way to make money is not to lose it, but it's just the truth, man. It's just the truth. So those are a couple different types of cryptocurrency allocations. Here's some allocation amounts. It's just all percentages. If I had $100,000, I'm just using round numbers, and I wanted to put 35% into cryptocurrencies, that'd be 35 grand. It's easy, right? It's just math, just basic. If I had 100,000, I was going to put 75%, it'd be 75 grand. So it's just percentages. That's how that works. And then I'd want to diversify within the crypto allocation. So this is where you guys are really, I think, having some sticking points. So now I've decided, okay, I have $10,000. I'm going to put 50% into crypto. That's $5,000. Great. How much should I put into every position? Is 1,000 enough to put into a position? I don't know. Let's take a look. So I would look at a conservative crypto portfolio. I would want to spread that around. And now this gets deeper than what I've talked about on video with you guys. I've told you guys, how much should you put into a position? Anyone? No, I never said that. Okay, we got 2.5% to 5%. That's what I've always said. 5% in the long term, 2.5% in the short term. And that's really good advice, and that works really well, and you guys can do really well with that. We're going deeper. This is next level stuff, okay? So you can just go, okay, I see all the Jarvis portfolio. I'm going to pick 20 to 40 of them, 5% here, 2.5% there, boom. And then that works, and that's great. But if you really want to go deeper, this is where we go deeper. So now what I would do is I'd say, well, all these cryptocurrencies are not the same. Ethereum or Bitcoin is a large cap coin and is more stable. It's not going to go up 10 times from where we're at today, but it's also not going to go down that much. This little coin called Fusion could easily go 10 or 20 times, but it's also more volatile. So you have to adjust for risk. So I might go, well, shoot, I'm going to put 40% of my cryptocurrency allocation into large cap stuff. And I'm going to put the 60% into the smaller, more volatile, riskier stuff. Or I might put 70% of my cryptocurrency allocation towards big cap safe stuff, and then I might put 20%. So basically like 45% would be in large cap, 25% would be in mid cap, which would be over $1 billion cryptocurrency would be a large cap. From 100 million to $1 billion would be a mid cap. Anything under 100 million would be a small cap coin. So we're trying to find those gems, those small caps. Those are the ones that are going to have the most growth for us. And those would be small caps. So I might only want to put a small percentage into that because it's so much more volatile. It's more risky. Maybe I'd want to put like 5% into trading, and that's okay. Like in how many people know what FOMO is? Of course, right? We have, yeah, fear of missing out. We have all these like words that have come out in crypto, and we've been throwing around like Lambo. Everyone talks about the Lambo, and we have FOMO and FUD and whatever, right? But we all have FOMO. We all have fear of missing out. I have it. I tell you guys not to have it, but I have it, right? I mean, how can you not, right? These things, all these coins are shooting up so fast, and it's like I'm only giving you guys 1 or 3 coins a month. But what about that one? What about that one? What about that one? And you want to chase those. And I'm here to tell you that that's okay, chase them, but have a good strategy around it. So maybe I have $10,000, and I like to use round numbers, I'm sorry if it sounds too big for you, but if I had $10,000 I'm going to put into crypto, maybe 1,000 of that I'm going to break off, and that's just what I chase all those little hot picks with. And that's okay if that's what you want to do, but you have a strategy for that. Okay, because I don't want that to wreck my total portfolio. That's the thing. Now, that's a conservative. On an aggressive, maybe I put 20% towards trading, and I put 15% in ICOs. A lot of you guys have asked me about ICOs. I've had conversations about ICOs with you guys. I think they're very risky. I don't know if the risk and reward ratios pay off for me personally, but you can make a lot of money. But if you want to do it, you need to have a good strategy around it. So you'd say, I'm going to take 15% of my portfolio, and I'm going to put those just into ICOs. And I'm going to show you how to do that. And then maybe I'd put 20% into small cap, because that's the most explosive, most volatile, 20% in mid cap, and 25% in large cap. And these are just guidelines, right? So you can kind of start to think about this. But really, it's the strategy that I'm trying to like show you guys. And so once I've done that, once I've figured out how much I want to put into an allocation like cryptocurrency, then I decide of my cryptocurrency allocation, how do I want to diversify within that allocation? Then the next thing is, how much do I put into each position, right? So that's the position sizing. Size matters. How much do I put? I'm talking about position sizing, guys. Come on. Get your mind out of the gutter. So now that I've decided how much I have to put into cryptos, and then I decide how much I want to put into each allocation within that cryptocurrency, how much do I put into each position? So if I'm going to put 15% of my crypto allocation into ICOs, for example, how much should I put into each ICO? That's a good question. I need to diversify within that ICO. The problem is that ICOs are super risky. 46% went bust. But the ones that get it right make up for the losses. As a matter of fact, if you would have put money onto every single ICO of 2017 with the blindfold on and just put money across every single one, you would have made 1,300%. It's amazing. Let me tell you that the stock market has averaged 8% for the last 80 years. 8%. It had its best year in history last year. The S&P did 19%. So to make 13% isn't just good. That's like, it's unbelievable. And that's just blindly. I just put money across every single one. But the problem is, if you just pick one or two, you have a 50-50 odds of getting struck out. So I need to be able to play a wide enough range of them that my wins can make up for my losses. So I can't just go pick one or two, like, oh, that sounds good, I'll put $1,000 on it. Like, you have a 50-50 chance that it's going to go bust, and that $1,000 could be half of your portfolio. And now you're out of the game. I mean, potentially, you lost half your portfolio. So the amount that you put into each position really, really matters. I've always talked about, I like even position sizes. Now, even position sizes protect the portfolio, and it protects my total portfolio. And I talk about even position size, but it doesn't have to be like all my cryptocurrency plays are even position sizes. It's all my position sizes within my one allocation of the same size. So I have $10,000 in cryptocurrencies. Of that, $2,000 is going into ICOs. And of that $2,000 going into ICOs, every ICO will have the exact same position size. That's what I'm talking about. Those position sizes could be $200 each, where I might put $1,000 into Bitcoin. Because within each cryptocurrency allocation, I have even position sizes. And that's how I spread my risk. That's how, if I am going to do ICOs, I'm going to make sure I have enough ICOs that if I lose on 5 out of 10, I have enough that I'll play the odds. I'll have 5 winners. If I only play 3 ICOs, like I could hit 3 strikeouts in a row, and that would suck. So here's how even position sizing helps us stay profitable. On the left, uneven position sizing. If I had position 1, I put 5,000 in. Oh, I heard this coin's the hottest coin in the world. I feel really good about it. I met the team. They're in my hometown. Whatever. You feel really good about it. You put $5,000. Then you open up 3 more with $1,000 each. Position 1 loses half. The other 3 make 30% each. Stock market did 19%. That was awesome. So 30% is really good. My portfolio lost 20% because position 1 was too big. On the right, all 4 positions are 1,000. Position 1 still lost 50%, the same. The other 3 all won 30%, the same. And we don't know how much money we made because the slide cuts off. But I think it's 10%. I think it's 10%. So the point here is that even though the win-loss ratios were exactly the same over four positions, one, I lost 20% of my money, which means now I have to make back almost 50% to get to even. The other one, I'm profitable by 10%. So that's why having even position size is important. And then, how many positions should I have? I know some of you guys saw me on video like 2 weeks ago, and I said I was talking about how I spent the weekend going through my portfolio. I spent so much time digging for gems, reading white papers, talking to teams, and trying to help everybody else that I neglected my own portfolio. What do they say? Like the shoemakers' men have no or sons have no shoes, or something like that, right? Like you neglect your own stuff. So I spent the weekend going through my portfolio, and it was pretty hard for me. It took me a weekend because I have like multiple like hardware wallets and accounts across everywhere and whatever. And I had like 55 positions open. I was like, dang, that's way too many. So I've been trying to knock that down. I've identified the 25 I want to keep, but I'm having a hard time. I'm having FOMO. I don't want to miss out. I don't want to cut these things. But so I think that how much we want to put into each allocation depends on how much you allocate to the position. Ultimately, again, talking about percentages, not dollar amounts. I think as an investor, 2.5 to 5% per position is the sweet spot. That means somewhere between 20 to 40 positions. If I was a trader, like someone who's like a professional trader, I'm just buying and selling them all day, I would probably only want to put like 0.5% to 1% per allocation. So trading is a lot more risky. You're going to lose 4 out of 10. And if I put 10% into each allocation and I lose 8 in a row or 10 in a row, I'm out of the game. But if I put 1%, then I have 100 tries. So that's why I do that. Speculators, about the same, 0.5 to 1%. So if you want to know, should I put $1,000, if you ask me, should I put $1,000 into that position, is it enough? Somebody asked me that. I'm not going to call you out. I would say, I don't know. How much do you have in cryptocurrencies? How much where does this one fit into that allocation? And then, how much do you have for that allocation? And then what does that equal percentage-wise? So ultimately, my answer to you would be, I don't know. I wouldn't put more than 2 to 5% of your allocation in that position. And whatever that is, that's what it is. Now, the beauty is, I think they're asking, like, would $1,000 have enough leverage for me? And I think that's what they're asking me. Is if I put $1,000 in it, would it be enough to move the needle? Should I even bother? Because typically people say, I don't have enough money to invest. That's the old way of thinking, because Wall Street gives us such horrible returns. Don't even bother putting $1,000 in. Like, why? I'm going to make $3 back? Like, I'd get more enjoyment just going out for a nice dinner. But $1,000 on Ripple in December would have turned into $20,000 by January. So to me, I have a pretty good portfolio, but $20,000 to me is still a lot of money, and I'm sure it's a lot of money to you guys too. So yes, $500 is a lot of money. If all you have is $50, put $50 in. $50 is fine. $50 could turn into $5,000, right? That still moves the needle. So think about percentages, 2.5 to 5%. It's all about risk to reward. The position sizing, so I talked about this, keeping it the same size. We don't want to risk too much because it can wreck our whole portfolio. What happens is if I have too much in one allocation and it goes down, my entire portfolio suffers. And I don't want one position, one bad choice to ruin my whole life. That's what I'm trying to prevent. Spread my risk around, spread it around asset allocations, 2.5 to 5%. I get 20 to 40 positions. It's not as sexy as putting a big amount of money on. If I put $5,000 on and I win big, that's really cool. So I know this isn't quite as sexy, but protecting our capital is the most important thing. I live in California, so I'm pretty close to Vegas. I've been there a bunch of times. I'm not really a gambler. I mostly went for the parties. But I'm not much of a gambler because I don't like losing my money. And winning a few $100s is like, okay, but I just go blow the few $100s. But losing it sucks. I think of all the other things I could have done with the money. So winning the money isn't near as sweet as losing the money is bad for me. So I know if I put all my money on black and it wins big, yeah, that's cool and sexy and fun. And spreading it around and being meager with it isn't as fun, but it wins in the long run. And that's what we're here for. So here's about how many positions you have open. That's just basic math. Asymmetric bets, right? So we get way more upside than limited downside. And really that's a good point though. So the reason why we're able to spread our risk and diversify across other markets is because we can make so much money. That's why $50 or $100 in a position can be something big for you. Here's the power of asymmetric bets on the left. If I were to put $500 across 4 positions, for a total of $2,000 invested, 3 positions lost half, 50%. 3 positions lost half of my money, but one of them went up by 500%, which is totally reasonable. We do it all the time. I would be up 87%, even though 3 of the 4 lost half their value. In example 2 on the right, if I had done the same, $500 across 4 positions, and 3 of them lost everything, went to 0. But one of them went up by 500%, which again is totally reasonable. I still made 50% of my money. Look at that. 4 positions, 3 went to 0, which is most likely not gonna happen, but it did. And one of them went up by 500%. I still made 50% of my money. So that's why we diversify. That's why we use these even position sizes. And that's the power of asymmetric bets. Now, of course, if I was making the 8 to 12% that I could make in the stock market, that would never work. And then maintenance. So then balancing the portfolio. So now, hopefully, you'll take this information, you'll download the slide decks, you'll sit down, get out a worksheet. Okay, I have $2,000 total or $20,000 total. I'm gonna put 50%, which equals $10,000, and you'll do the math. And then you go, okay, and then you balance your portfolio and you get it all perfect. But over time, it gets out of whack. So out of time, some positions make way more, some make less, and now I'm all out of whack. So we want to rebalance. Once a year is really good. Probably no more than twice a year. Do it January 1st, it's your New Year's resolution. Do it on your birthday. Just pick a date so you can just kind of do it all the time. I would say probably no more than twice a year. And the way that you do it is easy. One position shot up super high, I take profits. A lot of you guys have asked me what we do when we take profits. I can take profits, I can distribute them down to my other positions to get me back up to my even position size that I want to be in. Okay, so that we want to rebalance it once a year, no more than twice a year is good. So we buy and sell shares to rebalance the appropriate allocation. We can add new money to low allocations to bring them back into balance, take profits. And smart. One thing I want to say about this is I know not everybody here just has $5,000 to put in. A lot of you might want to be putting in $200 a month or $500 a month or $5,000 a month or whatever that is. So a lot of you may be building your portfolio over time. So that's a little bit different. I didn't really address that here, so I'll talk about that. I'm sure we'll get some questions about it. So in that situation, what I would do is I would say, first of all, I didn't say, but let me say, never invest money you can't afford to lose. Never invest money that you need. It's an investment. It's not income. It's not like a cash machine. It's not a slot machine. I don't put money out trying to get money back. It's an investment. So I put money in that I don't need. And I did talk about that in the Create Life-Changing Wealth because I talked about we can stay in the game by not getting shaken out, why we're not too stressed out about it. So start with that. But if I was going to put money in, I don't have like a lump sum right now. I just want to put money in as I go. What I would do is I would think about like how much money do I make? How much money do I think I can save? Let's pick a period, let's say 6 months or a year. Okay, I think over the next year I could probably save $10,000. It's going to be $100 a month or whatever. So probably what I would do with that situation is then I would say, okay, well, I'm going to grow to 10,000. $800 a month, or I'm going to go to 1,000, whatever that number is, right? And then I would still come up with my allocations like I talked about, and then maybe it's only $20 on each position, on 10 positions. And then each month, what I would do is I would just keep adding onto each position. So I'd still want to follow the same guide. I would still want to have multiple positions open. I'd still want to have my diversification, my allocation. But I would just start very small. I'd have $10 on each position, and each month I'd add $10, $10, $10. So I'd do that. Instead of putting it all onto one position and then next month trying to open up a second, I would do it that way. So that's it. Being smart is staying invested, managing your risk. Managing your risk. We do that through asset allocation, regular investing, and then always reviewing our targets and rebalancing. So that's it. That's the key to success. So I think are we going to do some Q&A?
Yes.
Yeah?
I'm coming to get the mic so that I can run around for you.
So I can't give personal investing advice. What I can do is try and answer questions. We'll try and help you think through specifics. And we're trying to come up with answers. I don't want to be super vague. I want you to get what you need. And hopefully each person's answers will help the next person think about it. So let's do this. You guys think that's helpful so far? I hope. I know it started out a little general and vague. I tried to get kind of narrowed down and specific for you. I know it's simple, but it's kind of a deep topic. So.
Okay, who's got a question? Go ahead and put your hands up, and I'll make my way running at you as quick as I can.
David Nichols, Atlanta. Mark, I think I've heard you say on one of your podcasts that you never sell Ethereum. So can you give me a little bit of the mindset behind that, and then what do you use to trade altcoins? Do you use Ethereum or do you only use Bitcoin?
I'm the hodler. I don't ever sell anything. So. Except Bitcoin. I don't really hold Bitcoin. I hold Bitcoin in regards to getting in and out of other positions. It's not really a position that I actively try to hold on to. I have 1% of my total cryptocurrency portfolio allocated to cryptocurrency or towards Bitcoin. But really it's just my exchange medium. Ethereum is my hodl. I don't sell it ever. So I know that on some exchanges you can exchange other currencies. There's other pairs, right? So an exchange means you're exchanging coins. Bitcoin is the reserve currency, and I always just exchange in Bitcoin. There's more liquidity there. You're typically going to get better prices there. There's more options there, so I always trade in Bitcoin, and I don't sell my Ethereum, if that helps.
Thank you. Next hand.
I think you covered this. Can you repeat, if you don't mind, what you said about cleaning up your portfolio, especially as coins are added to Jarvis?
Yeah, so there's a lot of coins in Jarvis now. I don't know how many, 40 or 50 would be my guess. I'm not exactly sure. And I did say that I cleaned up my portfolio, and I'm trying to narrow it down to about 25, which means I won't be holding all the coins in the Jarvis portfolio. And you guys don't have to hold them all either. Every one that is on there is a coin that I own or have owned. Well, I did own. I had 55 of them. I had too many. It means I even owned more than were on the Jarvis portfolio. But I just don't, I think once you get over 40, I think diversification is key, but at some point you have diminishing returns. And so I want to make sure I have enough in a position to get me the returns I want, but not too much where it wrecks me. So I think about 30 or 40 is the sweet spot there. I don't know if that answered your question.
Sorry. Thank you.
Okay.
Okay, my question is, I know a lot of us in here, had we had this information or taught at a younger age, that we could be so much better economically, just everything, just for us. So where did you learn this information from? Because like this type of stuff wasn't introduced to us in the inner cities and stuff like that.
We were being,
huh?
It wasn't me either.
So my question is, what sparked the energy? What gave you the motivation to get this game? Where did you get this from?
I like your shirt, by the way.
Thank you.
That's cool.
It was custom made too. This is my company, Beyond Blessed. Everybody, yes. The shameless plug. I do have them for sale.
Well, break me off one after
I got
this.
you one. I got you one though. For real, I have one.
So that's a great question. I know Dr. Watkins talks a lot about financial education. I talked about how awesome his presentation was this morning and how important that was. I know he focuses on his community, you guys, all about financial education, but that's my passion too. And I know you talked about the inner city, but it's Common Core. All the schools teach the exact same thing everywhere. So nowadays, now it's all Common Core. The last couple of years, the federal government has taken over education. So every school, everyone's learning the same thing. They don't teach it to you. So my passion is education as well, because my kids aren't learning this stuff. I have a 13-year-old daughter. She's reading Capitalism for Kids right now. I talked to Sonia about that stuff. So my passion is education too, which is why I try and dig deep to bring this to you. But to answer your question, where did I learn this stuff? Reading, right? So we're here talking about investing, but the number one place to invest where you're going to get more return than anywhere, even more than cryptocurrencies, is yourself. And I know that sounds like cliche, but it's the truth. Because it's all about the way you look at things, because we can all look at the same thing and see something different, but my lens has changed. And so what specifically have I read? Really, I think the book that really maybe changed the whole trajectory of my life was Rich Dad, Poor Dad by Robert Kiyosaki. It's a very basic book. It's like almost like an elementary reading book. Very core basic principles, but so profound. And I think that book, I was like, dang, like, I get it. Like, I need to be over here. And then that led to like this thirst for knowledge. So my library at home is very extensive. I am barely got through high school, no college. So it wasn't through formal education, but I am a voracious reader. I probably have 1,000 books in my library on things that I care about. I don't care about what they're trying to teach in college. So lots of books on investing, marketing, psychology, business management, things like that. Regarding this kind of stuff specifically, I told you in my origin story how I lost everything and I was like, this is never going to happen to me again, and I'm going to figure this out. And I started subscribing to subscription newsletters. So I started following, there's a publication called Stansberry Research. They make like 15 different newsletters, from how to invest in gold and silver mines, emerging markets, China opportunities, options trading, bond trading, big cap stocks, etc. Those subscriptions cost anywhere from $2,000 to $5,000 per year. They're not cheap. And I've probably spent $100,000 on them over the last 10 years. Not because I could even really afford them, just like you guys spent money on your DU membership, right? It's an investment. I bought this newsletter and it was $2,500, and that was a lot of money for me. But it made me $5,000 back, and look at the education I got. And then I bought the next newsletter. And now today I probably have, I would guess, somewhere between 6 to 7 financial newsletters that I subscribe to. I probably spend $20,000, $30,000 a year on that. And honestly, it sounds maybe ridiculous, I don't even take any of their investment advice. I don't, or their trades. I don't, they send me, it's kind of like what we provide to you, right? Here's a research report, it tells you what the action to take. I read the research report, I don't take that action. I ain't buying that crap. But I keep paying for the education, and so that's really where I've got most of it. But books, there's plenty of books. Now there's a lot of really good videos on YouTube. And so I watch, you can find the smart guys. So find someone who's like talking stuff that you like, and then just start following them. So you got me. So anyway, I hope that helps. I hope that helps. Thank you so much. I'll wear it. That's like a Bitcoin logo, right? That's a Bitcoin logo, right? Yeah. That's what I thought, yeah. I told you guys on my last presentation about making life-changing wealth, I am so excited, and I'm sure you can probably tell in my voice, I tell people all the time, to be where I am at today in this, yeah, go ahead and take a picture. No, but seriously, but seriously, the reason why this is perfect is because to be where we are today in this, with this opportunity, it's just never been had before. This wealth transfer that we're about to be into, and so I'm super excited about it. So anyway. I'd put it on right now, but Sonia's making me wear this thing.
So I have been building my long-term HODL positions using Jarvis, but if you can give me some tips on how I can maximize using the short-term plays. I know you've mentioned that sometimes the short-term plays may go into long-term holding positions, but I haven't really gotten there in my mind on how I can really play those positions outside of just putting 2.5% in. So if you can elaborate on that. And then my second question is, you don't do much for us with the ICOs, but where might I go and look towards getting information on how to evaluate ICOs, like Jarvis has the 2 questions, 3 keys, to build my mindset on what ICOs could be good?
Okay, so she asked about the ICOs. So the big problem with the ICOs is that we talked about yesterday, the ICO revolt, the regulations that have come in. So you can go gamble away every penny you have and take credit out to go gamble that away, and you're never going to get a return on that. And you can go buy as many lottery tickets as you want, but the government has to prevent you from losing money in investing. So because of that, average people are not allowed to invest into ICOs. And I think it's kind of lame, but it is what it is. So most ICOs that are offshore don't allow U.S. residents to get in them, and the ones in the U.S. now are requiring you to be an accredited investor. So you'd have to be able to prove that you're an accredited investor, which is like you make more than $200,000 a year. So that has kind of brought a little bit of an end to that, unfortunately. Now, you can find some here and there that you could probably still get into. There's a bunch of websites, and I can't really think off the top of my head, but if you just went onto Google and put like ICO tracking or ICO lists, there's websites that like list everyone that's coming out, and they do like their own rankings and stuff like that. But unfortunately, the SEC kind of, like I said, shut the music off on that party. And for people who are not accredited, there's not a lot of opportunity there. And I don't do it either because the risk to reward ratios just aren't there for me. So it's not something that I do personally. So I would just say that. Don't feel like you're missing out big time. I hope that helps on that. As far as how to play the 2, I talked about 5% and 2.5%. That's the easiest way to do that. You can think about the short-term ones. They weren't short-term. They're called fast movers. And the reason why they're called fast movers wasn't because I'm expecting them to go up fast. It's because only one full research comes out a month, but sometimes there's other good deals that I need to get out there, and I just don't have time to put the full research report. But you could look at those as ones like if you only wanted to hold like 30 or 40 positions, you could sell some of those probably first before the long-term ones. What I'm gonna start helping you guys do, because this is what I'm doing, is looking at all the positions and identifying where they fit in. So for example, we have Bitcoin and Litecoin open. Those are currency plays. Then we have like Ethereum and Neo, right? And those are like platform plays. And then we have AST and 0x, and those are decentralized exchange plays. And so now we're gonna start breaking the portfolio down into categories. One section that I'm super excited about right now is the interoperability plays, which is the Icon, the Fusion, and the Wand chain. So that's like a whole section right there. So we'll start coming out with that, and you can start putting your allocations into like different places like that. So we'll come out with some of the stuff like that pretty soon.
We are going to take one more golden
Oh man, I went too long. Sorry guys. I can be shorter.
All right, fine. We'll take 2 questions. You're gonna make me.
Jared Johnson, Richmond, Virginia. You may have already answered this question when you mentioned rebalancing, but I'm thinking all this wealth that we're going to amass, when we finally get to the point where we're like, okay, we've made all this money, my question is, okay, what do I do with it? So reinvesting.
Do good with it.
Do good with it, absolutely.
Do good with it.
Absolutely. So do we rebalance? Do we take that money out of crypto and put it into safer investments such as stocks and and real estates and bonds, so we rebalance it back
Definitely.
into safer investments.
Yep.
So the investing never stops. You're literally doing this
Yeah.
to the day you die.
You're doing it to the day you die. Yeah. Yeah, you would want to. We really dove deep into how to allocate in crypto and within crypto assets, but the beginning part was about being in stocks and real estate and whatnot, right? So, like I said, I only have about 50% of all my total investable assets in cryptocurrencies, and I own rental real estate. And my goal is, as my profits continue in real estate, I'm going to keep breaking off profits and getting more rental real estate. And once I have rental real estate that brings, and this number is different for you, but if I could make $5,000 a month free and clear off rental real estate, like, I'm doing pretty good, or 10,000 or 20,000, whatever that amount is for you. So for me, I'm going to as my crypto, because it's going like this real fast. So I keep scooping off the top and sticking over here, and put it back over here, right? So I'm diversifying around. So yeah, and it never stops. The rest of your life, and like what Dr. Watkins was talking about this morning, hopefully you're going to pass this down to your kids and your grandkids. And I made the comment when I was talking about the greatest wealth transfer, is that I'm trying to set up my grandkids. So it never stops, and hopefully you teach them and they can continue on. It really blows me away what the families like the Rockefellers have been able to do. Like, how can they continue to pass wealth down from generation to generation? Most times the wealth dies when the one patriarch, the founding family, dies. But they've been able to pass that down, and so yeah, it never ends. And you teach your kids, and and hopefully that keeps growing.
We got one more back here.
First of all, to my man there from Cali, I need to see you after. I need to get one of those shirts. Yes. Yeah, I need to get one of those. Secondly, Mark, I just want to kind of get an idea from you, kind of your thoughts on when do you think this market will be regulated?
Well, it already is. So as I told her, I mean, you can't get into ICOs anymore. So it's definitely regulated. I guess to kind of go into that a little bit more, it's acting as if it was regulated and not really regulated. So what that means is that they actually haven't come out with the clear-cut black and white guidelines, but they put everybody on notice that they think they're securities, and so now everybody's acting as if they were. But the SEC is going after companies, subpoenaing companies, criminal actions against companies. So they're already enforcing it as if they were. When will the actual black and white guidelines come out? I think it's going to be a while. I think it's going to be a while because they don't know what to do. They keep trying to take this brand new technology and put it into a 1933 time frame, and that technology doesn't fit. It's very, very strange, as a matter of fact, because we have all the government bodies fighting over what is it. So CFTC and the CBOE call it a commodity, but the SEC calls it a security. FinCEN, Financial Crimes Network, calls it a currency. So what is it, a commodity, a currency, or a security? Well, the SEC calls it a security, but you have to pay tax on it. Companies don't pay tax when they issue securities. So why are you taxing a security? Like, that doesn't make sense. So they don't even know what they're doing. Everyone's calling something different, they're acting different, and they don't know, and it's because it's everything. There is no classification for it. So anyway, if I had to guess, I would say at least a year, if not longer, before there's actual some stuff. Am I out of time? I'm gonna hang out, guys. I'll be hanging out if you guys have some burning questions for me.
Okay,
But
if I just keep adding questions though, don't run away, Mark, don't run away. Here's the deal. If I keep adding questions, we're going to be in here all night, and we have got a fiesta to get to.
I was going to say I have nowhere to go, but I guess I have a fiesta.
Yes.
I'll be hanging out at the fiesta. So come find me.
Okay, so a couple of housekeeping. First of all, can we please somebody?
My pleasure.
And you can go ahead and blame your good style on me. I'll take full credit. Thank you. Okay, anyways.
She told me, get a pink shirt.
So couple things. VIPs, let me hear you really quick in the room. VIPs. Okay, you guys have gotten a lot of attention already. So tonight, just to add to it, I want to make sure you guys know where to go. In the top floor of the South Tower, which is right by registration here in the hotel, it is called the Clubhouse. That is where this evening's fiesta or gathering will be. There'll be dinner. Go ahead and take your time to, rest, get dressed, all of that. Starts at 6:30, all right? Let me hear all of my other folks in the room, please.
All right.
Nobody has forgot you, and I was standing back there being like, all this love for the VIPs. What about the rest? What about the rest of us? Okay, so guess what? We have a special gift for you guys, too. Guess what? We have decided to give you guys all of the recordings from this event totally and completely for free. We're going to make sure that you guys get all of those once they're edited down, so you have each one of the segments from each one of the speakers. Go back and reflect on all of that stuff. Are you guys excited about that? All right, cool. Wanted to make sure that you guys didn't feel left out. Oh, see, everybody got jealous. Let me see what I can do. Let me see what I can do.
I don't know. Charles will probably send out an email link or something.
We'll make sure that you guys, included in all of that, we'll make sure that you guys have the slides too. Okay? Are you guys excited? Huh? I'll announce it in the morning.
No, that's not morning.
You had your phone on. I saw you had your phone.
I have to find out. I assume yes. Yeah, I got to find out. I mean,
You just found out real quick for the people that's not VIPs.
I had a whole...
Okay, we wait till the morning.
All right, yeah. So you give you a reason to show up on time. I'm just playing. Okay, so sessions are ending for the evening. We will reconvene back here tomorrow morning at 9 a.m. How many of you are mothers in the room? Raise your hand. Happy Mother's Day to you guys. It is my first Mother's Day, so I am feeling especially nostalgic and missing my own mom. So happy Mother's Day to you all. We will be having a special Mother's Day brunch tomorrow for VIPs. Raise your hand if you're going to be here with us. Okay, good. That'll be really nice. Morning sessions will start at 9 a.m. for everybody. We're going to have some super exciting stuff and more Q&A opportunities. So whatever questions you have, make sure that you write them down. We want to make sure that you get all of the information that you came here to get. Any last minute housekeeping situations from anybody on the team? No? Oh, please check with Jessica on the way out. If you filled out an order form, we are missing a couple of people's information. I know you saw your names up here. So please check with her on the way out of the door. I hope you guys have an amazing evening, and VIPs, I will see you at 6:30.